In essence, 99% of the time, nothing's happening. And if you sell, then you'll probably make a mistake, because on the one day when something happens, that's when all the gains take place. Now, you also can't pick stocks. This chart is the return of the Magnificent Seven, or 7 stocks versus every other stock in the S&P 500 index. And what you can see is the index might be up 11%. 7 stocks are up 53%. Everybody else is zero. There is no return. Everybody's failing. 99% of the companies are failing to deliver any shareholder return. There's only a handful that are succeeding. And if you want to know something more blood-curdling, it's 7 stocks out of 7,000 publicly traded companies that are returning the majority of the returns. That's 1 in 1,000. At 99.9% of these companies, they're not beating inflation. You know, you might think that somehow you're doing a lot of brilliant things, and they're working very hard, but they're working very hard rolling a rock up a hill, and the hill is monetary inflation. And this is the big idea in corporate finance. If you're a stock investor or an equity investor, most companies cannot grow their cash flows faster than the monetary inflation rate of 7 or 8%. So they have to rely upon expensive buybacks. They have to buy their stock back. They have to dividend out their cash flows. They do acquisitions to try to get more growth non-organically, or they load up on debt and they leverage up their balance sheet and buy back their shares with debt so that they can get that shareholder EPS to go up faster than the 7% number. And of course, that's the standard finance playbook. But they end up buying lots of companies and overpay. They end up decapitalizing and giving away all of their cash flows. They amplify their risk. They create chaos and confusion. It makes them fragile, makes them hard to manage, prone to failure, prone to bankruptcy, and very vulnerable to takeovers by hostile competitors. So the reason all these companies fail is because instead of keeping their capital and holding it in their endowment on their balance sheet against a rainy day, they decapitalize, give all the money back to the shareholders, and they have one bad year. Then they're in trouble, their stock crashes, their employees quit, and the vultures circle, and they get taken over. And when they get taken over, you have a merger of 3, 4, 5 companies. The companies lay off and cut staff and cut headquarters cost, and people lose their jobs, and they discontinue product lines, they idle factories, and they destroy manufacturing base. This creates economic malaise. And the reason why is because the companies are decapitalizing per standard corporate finance, because they're only allowed to hold bonds, and the bonds don't keep up with the cost of capital. That means this equity is just impaired by unavoidable risk and liability. The typical stock portfolio is going to get that 7% return.
In the vast realm of financial assets, Bitcoin emerges as a paramount player, deserving its status as an apex asset. The significance of holding Bitcoin lies in its decentralized nature forged by blockchain technology. This peer-to-peer network ensures transparency and security, a fundamental departure from traditional financial systems. The finite supply of 21 million Bitcoins adds a layer of scarcity, akin to precious metals like gold. Beyond decentralization, Bitcoin has showcased remarkable value appreciation. Since its inception in 2009, the cryptocurrency has demonstrated a meteoric rise, outpacing many conventional investments. From 2010 to 2020, Bitcoin's annualized return was a staggering 196%. This impressive performance positions Bitcoin as a resilient store of value, attracting investors seeking a hedge against inflation. The increasing institutional adoption of Bitcoin further solidifies its apex status. Companies like Tesla and Square have allocated significant portions of their treasuries to Bitcoin, signaling confidence in its long-term viability. Notably, MicroStrategy's CEO, Michael Saylor, advocates for Bitcoin as a treasury reserve asset, highlighting its potential to outperform other forms of capital preservation. Bitcoin operates independently of geopolitical influences, offering a borderless and accessible financial alternative. This feature is particularly crucial in regions facing economic instability or hyperinflation, where traditional currencies may falter.
And on the other hand, over 100 years, over a long term, I would expect that Bitcoin will return 14%. And the reason why is because Bitcoin not only doesn't have the risk and liabilities of a company, Bitcoin has no labor, has no management, has no competition, has no technology cycles, has no regulatory headaches. It doesn't have the tax, it doesn't have the war risk, the tariff risk, etc. It doesn't struggle with all the problems companies struggle with because it's not in the real world and it doesn't have physical nexus or political nexus. But also, Bitcoin has all the virtues of a pure crypto decentralized network. It's cybernetic, digital, it's immaculate in its conception, it's immortal, it's incorruptible, it's global, it's indestructible. And so you can imagine as a technology idea or an investment idea, you're just always going to have an advantage over mortals doing things in the real world. And so your trading strategy, your investment strategy, your stock picking strategy, your diversification strategy, they just don't work. There is one winning strategy that's going to work. And the one winning strategy is hold the apex asset for a long period of time. And so Bitcoin is that apex asset. That's how you beat the market. The S&P index will look like it's benefiting, but at the end of the day, it'll just keep up. Gold will actually underperform because it's commodity and they're producing more of it. And then any kind of cash or cash derivatives or bonds, they're going to destroy value. Now, let's look at some real numbers. This is Bitcoin performance versus other assets since August of 2020. Why do I pick that date? Because on that date, MicroStrategy bought $250 million worth of Bitcoin and announced it to the world.
Considering Bitcoin as a long-term investment is a strategic move backed by several compelling factors. In its first decade, Bitcoin outperformed traditional investments, boasting an annualized return of approximately 196%. Bitcoin operates on a deflationary model. This scarcity is comparable to precious metals like gold, creating an intrinsic value proposition. As demand continues to rise, the limited supply inherently drives up the value of each Bitcoin. Furthermore, Bitcoin serves as a hedge against inflation, especially in times of economic uncertainty. Traditional currencies can lose value due to inflationary pressures, eroding purchasing power. Bitcoin, however, is immune to such central bank policies, making it an attractive option for preserving wealth over the long term.
So that's an important date for us. Now, what did Bitcoin do since then? This is through yesterday, I guess, or 2 days ago, November 8th. Bitcoin's up 199% while the world's in chaos and there's a lot of inflation. The S&P index is up 30%. The NASDAQ 24, gold is down 4%. Gold's not working. So the money that's getting printed doesn't flow into gold. Gold isn't money. People are either investing in tech stocks or other corporations or Bitcoin, maybe real estate. They're not investing in gold. Silver's even worse. Why? Because silver's easier to manufacture than gold is. It's less scarce. And bonds are even worse than silver. Why? Because bonds are just governments printing money. They're just printing more bonds, and so they're not working. Now, what do you do for your family, your company, your institution? Well, if you adopt the Bitcoin standard or you adopt the Bitcoin strategy, then you can use Bitcoin to fuel your growth. So when MicroStrategy invested that $250 million, Bitcoin was maybe 11,000 a coin. And then about a month later, Bitcoin lowered, it actually decreased to about 9,500 or 10,000 a coin. And everybody panicked except us. We doubled down. And our view was we'll just keep buying. So you can see MicroStrategy stocks up 284% through November 8th versus Bitcoin up 199%. So we were actually boosted by our Bitcoin strategy. And you can compare us to all the big tech companies, the Magnificent Seven like Google, Microsoft, Apple, etc. You can see Bitcoin outperforms them all, but we're able to outperform even Apple and Google because we're using Bitcoin as the slingshot. And you can see there's no safety. Even if you're a monopoly or a dominant player like Amazon, there's no safety. And if you look at enterprise software companies, they were our competitors. None of them can keep up with Bitcoin or us either. And so Bitcoin clearly gives you an advantage if you just dollar cost average and stay consistent. Now, Bitcoin's currently in a high growth mode. If you look at that number, 199% implies about 45%, 40 to 45% compounded annual growth rate. So Bitcoin's growing at 40% while that S&P is 7-8%. So that's a high growth Bitcoin.
Bitcoin has been surging with a staggering growth rate of 199%, signifying a compounded annual growth rate, CAGR, of around 40 to 45%. To put this in perspective, the S&P index, a benchmark for traditional assets, boasts a CAGR of 78%. This stark difference highlights Bitcoin's rapid ascent, outpacing the growth of conventional investments. Essentially, Bitcoin's value is skyrocketing at a pace almost double that of traditional assets, making it a noteworthy player in the financial landscape.